as I expect the price of gold to eventually go way up and the price of Bitcoin to keep falling, dragging down the price of the Grayscale Bitcoin Trust. But getting back to the stock markets, there are some very obvious reasons that stock prices are going down. And fundamentally, they still have a long way to fall. And it's amazing that so many so-called experts don't recognize the extent to which equity prices are at risk and how much lower they actually have to fall to the extent that the Fed actually follows through with what it is claiming it's going to do with interest rates and this inflation fight. Because higher interest rates directly destroy stock market valuations. And there's four principal reasons for that. So let me go over those reasons so it's perfectly clear why what is happening right now with interest rates is very bearish for U.S. stocks. Even though they've already gone down quite a bit and are in bear market territory, they still have a long way to fall because remember, stock prices were propped way up as a result of inflation and artificially low interest rates. So when you try to remove that inflation by raising interest rates, then prices are going to have to come crashing down to a level consistent with this new environment that companies are operating. But one of the reasons that high interest rates hurt stocks is because a lot of stocks have debt. And if you are a company and you have debt on your balance sheet, which of course corporations have record amounts of debt on their balance sheets, thanks to the Fed keeping interest rates so low for so long, lots of companies took advantage of cheap money by going into debt. And then what do they do with the money? They use it to buy back stock. But they bought back stock at inflated prices. In fact, as the stock market collapses and a lot of this debt comes due, a lot of these companies are going to be sitting on unrealized losses. They would have paid higher prices for the stock they bought, but now the money they borrowed to buy it is going to cost a lot more to service. And so as corporations that have debt have to pay bondholders more money to service that debt, that directly reduces corporate earnings. And the only way corporations may be able to deal with that debt is by repaying it. Well, how are they going to repay debt? Well, they have to unwind those stock buys. They have to take the stock they bought and sell it into the market to get the money to pay off their debt. But of course, when companies go from share buybacks to share sellouts, the share prices are going to collapse. And in fact, companies will probably have to sell more shares than they bought because the price is down. And so this weighs not only on their stock price, but on all stock prices. Now you have all this selling. A big driver of the bull market has been buybacks. Well, a big driver of the bear market is going to be sellouts as all the stock that was bought back gets dumped back on the market. There's another way that higher interest rates also